Well, let's stay on the markets, talk a bit more about everything going on more broadly. And we're joined now for that conversation by Steve Sosnick. He is the chief strategist over at Interactive Brokers. Steve, great to talk with you this morning. I'd love to begin by something Jared was referencing there, and that's Tesla. I mean, this has really been like the story of the year, and it's now going into the S&P at the end of next week. And I know it's a dynamic in the market that you are thinking about because even though it's a weird stock in a number of reasons, it is sort of a bellwether for sentiment. At least I think it's fair to say that it fits that kind of role. So, what does the S&P inclusion kind of mean to you, and how are you thinking about that event?
Well, first of all, thanks for having me. I think this is going to be a real bellwether in the market, and there are so many different layers in this stock. It's like peeling the onion to a certain extent. Basically, what I see happening is, first of all, you've got this incredible enthusiasm for Tesla. The stock's up about 55% since the index announcement. Now, that way outpaces the amount of stock that needs to be bought by even the most outrageous amounts of indexing money. So if you say that everybody who not only indexes to the S&P, but anybody who benchmarks to the S&P is going to be buying Tesla, you far outkick that coverage. And I actually was kind of expecting that they would be issuing some stock into the announcement. I kind of wasn't expecting it this soon, but it's such a logical place to sell. On top of it, you have an expiration that day. So you're going to have selling pressure in the other 499 stocks that are in the index now. And that's going to have some interesting effects occurring with this immense open interest in call options that we see. You're going to have stocks being driven right at the close through strikes up or down, and that's going to cause a little bit of chaos. Does this mean there's a buying climax in Tesla? I think so, but it's very hard. Anybody who's bet against this stock in the past has been decimated, so it's a tough call to make. I do think that's sort of the last great catalyst that we see, for at least for now, in the stock.
Steve, so if there could be that buying climax, the day that they are added to the S&P 500, is that a sell the news event, or the mechanics in the markets are such that Tesla shares will probably rise that day and maybe the day after?
I would not be willing to short it necessarily aggressively before the addition. Let's say up to December 18th. I just think that between the speculative sentiment and the actual real buying that has to go on, it's a dangerous short. And we can see that the stocks today, they're issuing $5 billion of stock. You've got this very minor downtick. And, again, with Tesla, all news is good news. So therefore, they're going to get out of some cash. They'll be able to raise cash cheaply. And so that's a tough one. Going beyond that, I do think you have the potential for real buy the rumor, sell the news setup, because you're going to have this buying climax. You have a lot of speculators who front ran this, and not all of them are going to be able to get out at the prices they want to. That could have a hangover effect for the few days and weeks after that.
Hey, Steve, it's Julie. I want to broaden it out beyond Tesla and talk about the VIX, which I know you watch closely. Is the VIX still the fear index? Was it ever the fear index? I mean, how should we be thinking about the levels of the VIX these days?
That's a great question. First of all, I think it's never been the fear index. It is not now, nor has it ever been the fear index. It was not constructed as that. It was constructed to be the best estimate that we can come up with for 30-day volatility in the S&P 500. Now, it has acted like the fear index because when markets rise, typically we see less demand for hedging, which is reflected in higher implied volatilities. And we see markets fall, people get a little panicky, and they come after volatility. They look for volatility hard because they realize belatedly that they needed to hedge. What we're seeing now, though, is there's a scarcity of implied volatility because of all the call speculation that we're seeing. All those people who are buying calls, and call volume is at records, call open interest is at records. There's tons of people who've discovered that calls can be, in a very speculative environment, can be a way to supercharge your speculation. But somebody's selling those calls, and whoever's selling those calls has to be hedging. All of us, the prices of implied volatility are going up. And that's why you see the VIX very stubbornly around the 20 level. Whereas, last week we saw all the four major indices at a high for the first time since January 18. At that point, the VIX was about 12. And I had people trying to convince me why it was a good short, despite it being a one-sided trade. Now you're a very different volatility regime because the level of speculation is so high. It's come unglued a little bit, and that's why you see VIX go up sometimes when the market goes up, because depending if there's enough speculation to keep option prices high, you see that reflected in the VIX. I think it's been great to call VIX the fear gauge. Over time, it's worked as the fear gauge, but it's not.
Steve, it's the time of year when your peers on Wall Street come out with all their price targets for the next year. We have seen a lot of bullishness. We've seen some analysts increase their price target 3 weeks after they first publish it. We've seen other analysts say that risks are skewed to the upside on their kind of range of forecasts. Often you see that on the downside. As you look at next year, are you concerned that sentiment is getting a little bit ahead of where the market might be? And I guess, are you also concerned that realized positive earnings next year won't really be a catalyst for the stock market to keep going up?
Oh, how dare you look at things with a glass half empty, Miles? Yes, I think sentiment is way ahead of itself. I think we're overlooking what's happening in the present for the future. Now, to a certain extent, that's logical. Markets should be discounting events in the future, but I think the highest likelihood of good news is being placed on the markets right now, and the amount of speculative money that we're seeing is driving sentiment to a certain extent. I think there's a lot of cash that has been looking for a home. I think that though it's somewhat dependent, some of the cash that we've seen has flowed in as the result of stimulus, which, the $1,200 checks, many of them got invested in the markets. I think people are benefiting from not from the student loan moratoria, in some cases from rent moratoria, which are all about to end. And, stimulus is not necessarily here. The Fed has basically said we're waiting for the government to do something, for the Feds to do, for the fiscal authorities to do something. You may get that into January, but so we've got a lot of potholes to get to before we get to the Emerald City on the other side of the yellow brick road.